Let's talk a little bit about auto loans or owning versus leasing. So, with auto loans, you get full ownership of the car after paying off the loan, and the payments are higher monthly than leasing. It offers flexibility because you have freedom to modify the car while also having no restrictions on mileage, right? So, no restriction on how far you can drive the car. And at the end of the term, you get to either sell or trade in the vehicle or just keep the vehicle, whatever you want to do with it. It's your vehicle. But for leasing, in terms of the ownership, you can only keep it for the duration of the lease. It has lower monthly payments than auto loans, but the flexibility is limited and requires you to keep under a certain amount of miles driven and requires you to keep the vehicle in good condition. And at the end, you have to return the vehicle. You don't own it, right? So although leasing has lower monthly payments, they often involve extra costs at the end, right? So if you do go over in terms of the or mileage, you have to pay fines and pay fees. And if you damage the vehicle in any way, wear and tear, you have to also pay for that. So let's talk a little bit more about auto loans. There are secured loans used to purchase new or used vehicles, right? These loans are secured against the car itself, and you can obtain them from banks, credit unions, and even some auto dealers. You can have a fixed rate, which remains the same throughout the same period, or you can have a variable rate, which can fluctuate over time, which is generally in sync with a standard financial index, which we talked about previously. These usually range from 12 to 84 months. Longer terms lower your monthly payment, but increase the amount of interest you're actually paying over the lifetime. Factors affecting approval and rates: credit score, debit to income ratio, loan terms, vehicle details, right? Better your credit score, better your debt to income ratio, and the loan term will affect how much you're paying monthly. And usually you get better deals from banks and credit unions than auto dealers. So there's direct loans and indirect loans. Direct loans are obtained directly from a financial institution. Indirect are facilitated through a dealership, but ultimately funded by the bank. Some very important additional points is that generally you want to get pre-approved for a loan to know how much you can afford. And you want to give a larger down payment because it secures a lower interest rate because you are seen as a lower risk, and it reduces the loan's overall cost. Make sure you read the contract that you're going to sign for the auto loan, because if they include a early repayment penalty, that could be a deal breaker. So some of these loans will penalize you for paying off the loan early because they want the full amount of interest. Because if you pay off sooner, you're going to be paying less interest. So a pretty common rule for if you can afford the car is the 24-10 rule. Financial experts will suggest following this rule as a guideline for car affordability. So according to this rule, you should be able to make a 20% down payment for the car, right? If it's a $200,000 car, that would mean a down payment of $40,000 for your loan. Your auto loan terms should not exceed 4 years, which is 48 months, because that more than that would increase the amount of interest you're paying. And the total of the car expenses, loan payment, insurance, fuel, maintenance, should not exceed 10% of your gross annual income, right? Other financial considerations. Lenders will look at your debt to income ratio, which should be below 36%, including the new car loan. So the amount of debt you have compared to your income, if that percentage is above 36%, right? So for every $100 of your income, you have $36 of debt. If it's above that, right, they'll start charging you higher rates and will require more fees. Credit score. Having a high credit score will get you better loan terms. And remember that cars depreciate quickly. So if you sink a significant portion of your income to a vehicle, it might not be the best investment strategy unless you have substantial wealth or income. right? So as soon as you drive a new car off the auto dealership, it loses a substantial portion of the actual value.